All right. The answers to this exercise are given on the next page, and you can have a look at these here. Uh, I will not spend too much time on these, but uh, but these are pretty straightforward in terms of whatever we have done in the last few slides, and trying to match the components on the right to the elements on the left. So have a look if you have got have you got these right, and if there's any question or doubt you have, feel free to reach out to us, and we can discuss that over an email or a call. Okay. Now, having looked at different balance sheets, or having understood the balance sheet, what I wanted to give, what we wanted to give you a flavor of is an actual balance sheet of a company. What we have done here is we've looked at the balance sheet of a company called ITC, which is the Indian Tobacco Company, the makers of cigarettes, FMCG products like Bingo, Fiamma de Ville, as well as the hotel chains of ITC, Sheraton Hotels. And we've just pasted a snapshot of their balance sheet to look at how does it look, and if there are any terms which we have not understood, or which we have not looked at in the during the course of the content that we have provided to you. Let's start from the left, and let's look at the equity and liability side first. So that's because that's how the company had presented its case. So starting from the top, we have shareholders fund, we have share capital, reserves and surplus, something which we have already gone through. There's a new term called minority interest introduced here. Now, what minority interest represents is sometimes companies sell a large chunk of, sometimes there is a third party company investor who has a significant portion of the company, or owns a significant portion of that company, and that gets shown in minority interest. So this actually is part of shareholder funds, but because the amount is sometimes significant, it is represented separately. So this minority interest represents the stake of a third party company into ITC. Right. The other elements, I think we are pretty straightforward. We've understood them. We've already gone through them. Long-term borrowings, deferred tax liabilities, other liabilities, long-term provisions, short-term borrowings, trade payables, total out, and then those are further broken down into a couple of other smaller items, other current liabilities, short-term provisions. The total current liabilities of these companies are close to about 14,945 crores. Long-term liabilities are close to about 2,000 crores. Shareholders' equity and minority interest is close to about 34,000 crores. That gives a total, the sum of assets, the sum of liabilities and shareholder equity, uh, equity as 51,200 crore, 200 odd crores. Let's look at the asset side now. And on the asset side, we have fixed assets, which are broken down into tangible and intangible. Sometimes companies give intangible assets separately as fixed assets, separately from fixed assets, because fixed they would typically consider as tangible, and you're not intangible such as goodwill and trademarks are listed separately. It just depends from different accounting practices the companies follow. This is quite interesting. Capital work in progress, tangible assets. So these are essentially when a company is making an asset, or in the phase of, say for example, setting up a new factory. During that time, the factory is not generating revenues, but there is money already invested into setting up that factory. So all that money typically is represented as capital work in progress, because that asset is work in progress, not yet ready for production. And similarly, you have intangible assets under development. So this would essentially be the amount that the company has spent on research and development of a particular product, or essentially around research and development of a particular product that the company is investing in. Goodwill on consolidation, we have already discussed, comes when a company makes an acquisition. Non-current investments, deferred tax assets are similar to deferred tax liabilities, but these are essentially the obligations that the government have or the tax authorities owe to the company, rather than the so that's why it comes in the assets. Long-term loans and advances. So these are on the asset side because these are the loans and advances that ITC has given to some of its would have given to either its vendors or its customers, and those are the money that it is waiting to receive from them. Large organizations typically do that to help some of their customers or some of their custom vendors, you know, being able to provide to ITC the products that they require or buy from ITC the products that they want. That's why this item is on the asset side. This is the obligation that others owe to ITC and not what ITC owes to others. On the current asset side, again, it's pretty simple. The only line item I think which we have not discussed is short-term loans and advances, but this is very similar to the long-term loans and advances on the asset side, which is the money that is owed to ITC by vendors or customers. The interesting point which I would just like to highlight right now is what is called as note, and you would see under note you have these numbers 1, 2, 3, 4, 8, 5, 6, 7, 8, 9, 10 up till 18. Now what happens is that if you open any company's annual report and when you look at the balance sheet, below the balance sheet and the other financial statements, we have what are called as notes, which are basically more descriptors of the line items, or it provides much more detailed description of how that line item, that the value that you see here gets added or how that sums up here. So for example, if you talk about long-term borrowings, which is of 42.81 crores for ITC, the notes will give you details of what is from which bank, how much amount is due, what is the rate of interest, and how that adds up to 42.81 crores across all the banks. Similarly, if you look at other current liabilities of 4,108 crore, the company would have in the notes given you a more detailed breakup of how these add up, what are the different components of it. These are extremely useful when you're doing a very detailed financial analysis of a company and try to understand line by line why is one item higher and why is lower as compared to any other company or as compared to the previous period. And the notes have a whole lot of information that you can go through to understand the company slightly better. So we would suggest that when you pick up any annual report of a publicly listed company, under the financial statement section, when you look at the balance sheet and the income statement and cash flow statements below that, you'll see the notes. So do go through the notes to get yourself comfortable with that to what kind of information is typically presented in those notes. So it will help you understand the company slightly better. We have a couple of other exercises for you now, another set of exercise. So this exercise is essentially, we've made some numericals for you guys, for you to kind of practice your understanding of the concepts of balance sheet, both in terms of mathematical as well as conceptual, that how if one side of the balance sheet gets impacted, then what will be the impact on the other side and where that impact will be visible. So we'll give you a few minutes to go through these questions. There are about 7 questions, 4 on this slide and 3 on the other. What I would request you to do is just to list down your answers on a piece of paper, and then we can match them with the results with the solution given on the next few slides. So go through these in detail, and we'll get back to you with the solutions. These are the remaining 3 questions. Again, have a look at these. Okay, we'll now look at the answers to these questions. We've also given you an explanation wherever required, so that you are clear that why this particular choice was selected or why this choice was correct. If you have any questions, concerns around these choices, please feel free to reach out to us and we'll be happy to answer your queries and address those concerns. Okay. Moving ahead, another set of exercise for you. This one is quite simple: true or false, 3 sets of statements. Go through them and see which one is, which one is true and which one is false. Let's look at the answers now. The first one talks about the whether the value of the property, plant, and equipment is the fair value of the assets in the market, or it's the book value. So it's actually not the fair value; it's the book value. The book value means that it is the value of the asset at which it was bought, and then the value is reduced further based on the depreciation principles applied over it. The reason why we are the reason it's not the fair value is, for example, land. The company, that the value that you see on the balance sheet would be depreciated based on the principle of the depreciation employed by the firm. But in actual, the land price might have gone up significantly because of real estate costs have gone up in that area. But the value that will be shown on the balance sheet would still be significantly lower than the actual fair market value of that land. The second statement is also false, because it's not the amount that is reported in the balance sheet is not the fair value of the company, because fair value would be higher or lower based on the quality of the asset and based on the premium that the investors would look at over their investment. So most often the fair value is significantly higher than the amount that is reported on the balance sheet of the firm, especially for companies which are performing well. And the third statement is directly flows from the second one, which is that the book value of the corporation is the amount recorded on the balance sheet. So yes, as far as the book value is concerned, you can buy the company. The book value is equal to the shareholder equity, because it's the difference between the assets and the liability. And the amount that is left is actually what you can, you can theoretically purchase the company for, but practically that will never be the case, because the fair market value would always be higher, or in very few cases lower than the book value.